Okay, so moving into chapter 4 and talking about federal income tax, what do you think the primary purpose of the federal income tax code is?
Collect revenue.
That's what 99% of people would say. It's revenue generating, right? Which clearly it is. But it's also a really powerful tool for economic and social policy. Anybody have any examples about how our tax code directs economic or social policies?
Mortgage deductions.
One more time.
Mortgage deductions.
Yeah, you get to write off the interest on your mortgage. That's a social policy. Home ownership is, it's social and economic. Home ownership is desirable from a societal standpoint, and it's also an asset building or net worth building tool. So that's desirable, right? Current tax code, current administration talking about maybe removing the mortgage interest deduction from our tax code. One of the things that's being currently played with. So we'll see what happens there. Any other examples? How about charity? Can you write off deduction? Can you write off contributions to charity? Yeah, societally desirable, right? What about something like purchasing an asset, a productive asset, like a piece of manufacturing equipment or something, and instead of depreciating it out over a long period of time, there's a code section in the IRS that lets us write that asset off right away. Why is that desirable if you're a business owner?
Creates production and jobs.
Yeah, and you get the tax break all in 1 year, right? So it helps to fund the purchase of the asset that supposedly trickles down and creates wealth for more than just the entrepreneur himself or herself. So those are just a couple examples. What we're going to be dealing with in here is tax code specific to running payroll. So things like putting money into a health savings account, or funding your 401k, or paying into a flex plan are all pre-tax activities. Okay, so it makes the calculation, like how tough can this be, get a little bit more convoluted. Okay. If it wasn't convoluted, we wouldn't have a 45-hour class based on this topic, right? Okay, and convoluted is not the right term. It's just, and additionally, also, payroll is now one of the primary ways that we administer the Affordable Care Act. So that's yet another example of how tax code is utilized to implement social and economic policy. Okay. So, and you're going to need your books if we get to the calculations today, because the tax code is in the back. Okay. So, first off, and not to beat a dead horse, we've talked about this a number of times, in order for you to be liable to worry about withholding federal income taxes from folks that work for you, you've got to be in an employee-employer relationship. In other words, if it's an independent contractor, it's a non-issue, right? It's got to be an employee-employer relationship. We know that. This last bullet, I don't know if you've heard this term before, statutory non-employees. That statutory means what again?
By law.
Yeah, so it's written into statutes, into law. And basically, there's a number of categories which are, according to law, classified as non-employees, and therefore in no situation would you ever withhold FIT from them. And the examples they're giving you here, this isn't an exhaustive list, but it's the examples that are probably the most widely used, is anybody that's in direct sales or in real estate by nature are statutorily non-employees. Okay, no mysteries here. Looks very similar to the list for FICA. What is covered under FIT withholding, all your wages, all your vacation pay, all your bonuses. New term here, though, that we're going to be using quite a bit in this chapter that you need to tap into, supplemental wages. Anybody ever heard that term or know what it is? So supplemental wages are things like severance pay. So thank you very much, but we're not going to need your services anymore, and here's 6 months' salary. Okay, that's a supplemental check. Retroactive pay is supplemental. Retroactive, that happens every year here at the university. Like right now, here we are at the end of February. We're just finalizing negotiations for the contract year that started July 1st. So they'll cut us a check for the difference between what we were paid and what we should have been paid according to the contract for the last, whatever, 8 months. Okay, that's called a retroactive paycheck. That's a supplemental check. Okay, and there's a couple other examples. Those are the two biggies. Why am I making such a big deal about this? Because supplemental pay is taxed differently than regular pay. Okay, it's taxed differently than regular pay, and we'll talk about that as we get into this a little further, but just keep that in the back of your mind. Whenever you see that word supplemental payment, you can't just assume that you're withholding federal income tax in the same methodology that you would any other kind of pay. Okay, tips, same. What are our two kinds of tips again, now that we're getting more sophisticated?
One is
Allocated and reported. Which one do I withhold federal income tax on, and which one do I not hold federal income tax on?
reported withhold income tax on allocated.
Yes, ma'am. Reported tips, clearly. I, as the employer, have got to worry about withholding federal income tax, FICA, all of that, right? Allocated tips, not so much. How does the government get their income tax on allocated tips then? Remember? Yeah, if you had allocated tips at the end of the year on your W-2, I think it's box 12 or 13, you're going to get a number that says allocated tips. And that needs to go on your tax return, and you're going to have to pay federal income tax and FICA on it. Okay. Taxable fringe benefits, cash awards. Hey, you did great. You were my best saleswoman. Mallory, here's a check for $1,000. Taxable fringe benefits, I'm going to go into much more detail on. And then the next couple slides is a replication of a figure from your book that talks about different kinds of taxable income for FIT purposes. Okay. So things like disabled workers' wages, so this is for a specific sort of disability payments. Drawing account advances. I mean, I'm not going to sit here and read these all to you, but clearly you should be aware of what these are. I'm going to talk to a few of them that you see oftentimes in a little bit more depth, but go ahead please and review figure 4.1. Did you know that you have to pay federal income tax on unemployment? You don't in Montana. You don't. It's a specific reduction in Montana. You don't pay state income tax on unemployment comp. Okay. You don't pay state income tax on tips in Montana. So if you've ever filled out an MT2 or an MT2 EZ, which is our tax returns in Montana, those are specific reductions. Okay. All right. Fringe benefits, non-cash fringe benefit. In other words, here's something you get that isn't money, but is of value, okay? Let me give you some examples. If I pay your health insurance premiums if you work for me, that's a non-cash fringe benefit, right? And in this day and age, oftentimes that can be damn near as valuable as your wage, right? Is that taxable to you? Is that taxable to you as an employee? Anybody here ever worked for someone that pays their insurance premiums? Is that taxable?
In a box now, it's in a separate
It is in a box, but that's for compliance with ACA. Does that show up on your tax return as income?
DD or something.
Yeah, it is under DD. That's a special little code in box 14. Does that show up? Do you pay tax on that? You don't. And again, that's using tax code to implement social and economic policy. It's desirable, obviously, for an employer to provide health insurance. And now under ACA, in many cases, it's legally mandated. Okay? Again, stay tuned. That's obviously all in flux. 6 months from now, we might be having a very different conversation. So that's a non-cash fringe benefit that isn't taxable. Well, what is? These are all examples of items that are. So tickets to athletic events. My son lives in San Francisco. He gets box seats to the Warriors games or whatever to take clients. Is that taxable to him? It is. It is. Tickets to athletic events are taxable. Okay. Athletic club membership, they pay for you to join a country club, to join a gym, to join a spa, whatever. Taxable. Personal use of a corporate car. Have we talked about this? Have I given you an example of this? A little bit. Okay, because I couldn't remember if it was in the FICA chapter too. So can anybody reiterate what I said before? Or remind me what I did say? What does that say to you, personal use of a corporate car?
It's given a benefit to the employees.
Right, so say that you're a salesperson for me, and I give you, a rig to drive for work on sales. But I don't expect you to bring it back to the shop every night or the office every night and drop it off. You just keep the expedition or whatever that I've given you to drive around because you have to drive on crazy roads in Montana all winter, right? So obviously you're going to go to the grocery store, you're going to run your kids to Little League, you're going to do stuff on the weekends, blah, blah, blah. So you've got personal use of a corporate car, okay? What does that do for you? That means you don't have a car payment. You don't have to maintain a car. You don't have to, put gas in it. Well, you have to put gas in it. But so what you have to do is you have to log your miles. And then at the end of the year, I've got to take your miles and multiply it by some per mile number. 50 cents a mile, 20 cents a mile, $1.10 a mile, depending upon how nice the car is.
So like with gas, would you be able to write that out at the end of your
So, well, there's two ways of doing, this gets a little bit beyond our scope, but so if you work for me and I give you the expedition to go drive, I'm going to get a write-off as the employer, right, for auto expenses. And I can do that one of two ways. I can either take actual expenses, actual gas, actual oil, actual tire replacement, blah, 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 or I can take a standard mileage rate. And so based upon what I decide to do in my best interest, we're going to negotiate a potential reimbursement to you for miles driven. There's lots of different ways to structure it, and that's a really good question. It's a super important thing as a business owner to make the correct decision on how you're treating auto expenses if you're providing a fleet for your people. Okay. Frequent flyer miles, IRS says that's taxable. They've never gotten anybody to report the miles. It's never going to happen. People are kind of like collectively, I'm not going to report my frequent flyer miles. So that doesn't really happen. Stock options, taxable when you exercise them. In other words, when you turn that option into actual stock. Okay, what isn't taxed? In other words, what's specifically excluded? Qualified employee discounts. You work for United Airlines and you fly for free. Okay, that is not taxable. And the exact term escapes me right now, but the connotation of it is you get to fly as a United Airlines employee if somebody isn't in that seat, obviously. So it isn't, you're not taking somebody else's potential revenue. It would have expired if you didn't use it. So it's not taxable. If I have a tuition plan or I give you meals and lodging for my benefit, that's not taxable to you. De minimis, this third bullet, de minimis fringe. De minimis means super small. Like it's so small it's not worth tracking. Like I give you a corporate cell phone, and then that means you don't have to have your own cell phone plan or smartphone plan. So, but I don't make you track that, right? So that's de minimis. Okay, fringe benefits. So the first thing that I want to point out is up here on this first bullet. So we're talking now about if something is a taxable, non-cash fringe benefit, how do I tax it? How do I withhold on it? I can do it one of two ways. I can either withhold at a flat 25%. So say that I give you season tickets to the Lakers. 30,000 bucks maybe, I don't know, big dollar I'm sure. $30,000, let's say, is the value of them. I can either flat out withhold 25%, right, of the value of that, so 7,500 bucks from your paycheck. Or I can take that 30,000 and add it to your regular check over one check, 2 checks, 4 checks, 12 checks, whatever we decide to do. So flexible reporting, the option of treating the benefit is being paid on one or more dates. So I can do really whatever I want. Why would I want to parcel out that 30,000 over multiple checks? Exactly, that 30 grand, if I put that all on one paycheck and took tax from it, are you probably even going to get a check? Right? No. Okay. If I take that 30,000 and I divide it over 24 paychecks, let's say you're paid semi-monthly, that's, roughly 1,200 bucks a check, let's say. Then each check is going to have a little extra FIT withheld, right? $1,200 times whatever your highest marginal rate is. So it kind of spreads the pain out, doesn't it? My point is if you get tickets, season tickets to the Lakers or a country club membership or whatever, is it free to you? No, you're paying fit and sit and FICA on it, aren't you? So it's not free. I mean, it obviously doesn't cost what the face value is, but neither is it free. Okay, questions about this? So, and also, this is also introducing here the first time you've seen what is the flat rate on supplemental wages. And the answer to that is 25%. Now, does anybody remember the federal income tax brackets? What's the lowest bracket? You remember we had it on our tax tables? 10%. That's the lowest marginal federal income tax bracket, right? So it goes 10, and then 15, and then 25, 28, 33, and 39.6. So the 25% kind of falls right in the middle of the tax rates. Okay, so again, I'm just kind of feeding you little bits of information at a time, and then we'll do some calculations. And we know this. This is totally a refresher. You've got to withhold as an employer FIT on tips. You've got to report the tips by the 10th of each month to your employer. And then they've got to withhold FIT and FICA. And they've got to match the FICA. But only on the reported tips, not the allocated. And we also know that if you're a large employer, in other words, you have 11 or more employees at your place of business, that you have to run every month their sales, multiply it by 8%, and make sure that your employees reported at least 8% of their sales. And again, this is just really rehashing the tips. Most of you did fine with this on the exam. Traveling expenses. This is a new topic. Travel expenses or travel reimbursements is what we're talking about here. Here's what the situation is. If you work for me and you travel on my behalf, there's a lot of different ways that I can handle covering your travel expenses. One would be I give you each a corporate credit card, okay? But as a CFO, that's a little scary to manage, okay? Particularly if there's a lot of people and you got a lot of cards out there, right? You've got security issues, you've got potential misspending issues. That may or may not be the most desirable for my company. Another way that we can handle it is you go out on your own credit card or your own dime, and then you bring me receipts and I reimburse you. Or I can give you an advance. Here's $1,500 and da-da-da-da-da, and you bring me receipts and then we get even at the end of the trip. A lot of different ways to handle it. The issue here, and I have to make 100% sure that you understand this, the sole issue here is whether or not the organization has something called an accountable plan. And all that terminology means is that it's an Internal Revenue Code sanctioned reimbursement plan. In other words, they want to make sure that if myself as the employer is going to write off travel expenses, that I'm handling the process correctly. In other words, if I give you a couple grand to go travel and you bring me back $1,800 worth of receipts, I've got to have a time frame within which you give me the receipts. I've got to get my $200 back. I've got to reconcile it all. You see what I mean? So the Internal Revenue Code doesn't want me to be able to write off a lot for travel expenses if we don't have a tight process to make sure that it was actually incurred on behalf of traveling for my company. That's what an accountable plan is. It's just a piece of paper that says, here's our standard operating procedures regarding travel reimbursement, okay? If I've got a travel or an accountable plan in place, and then so IRS sanctioned rules, then any money I give you to reimburse you for travel isn't subject to withholding. And it shouldn't be. So you go spend $1,500, I cut you a check for $1,500, you would not be hoping to declare that as income and pay tax on it, right? Because all it's doing is getting you even. But if I don't have an accountable plan in place in my company, it is taxable wages to her, and I do have to withhold federal income tax on it. Okay, do you see the problem? And then hopefully she's going to turn around and this gets a little beyond our scope too, but then write it off as an employee business expense on her income tax return. But that's only going to happen if she itemizes deductions and it's greater than 2% of AGI, and there's all this other tax mumbo jumbo that goes into that. The long and short of it is McKenna's not going to be she's not going to be made as whole from a tax standpoint. So do you want to ask me questions about this? This is kind of a bear to explain. Has anybody ever heard of this? Okay, so what's your experience with it?
The county had a policy and you had, like you say, turn it in within a certain amount of time.
Okay, so you've seen the plan itself in play, okay?
I've never read it, I just knew there was.
Yeah, right, yeah, probably not something you're gonna read for giggles. Paul? You've used it at your company? Who do you work for?
I used to work for Elvis.
Okay, so same thing, when people traveled on behalf of the diesel company, they had very stringent rules about how they got even with the employer.
Yeah, the next day, we can go back to the mention.
Oh, they give you 24 hours, okay.
And then all of our.
You bet. And you've got to have them reconciled, and I mean, it's very stringent here, obviously, traveling for the university. If I ever do workshops or conferences, same sort of thing. And I mean, I can tell you, if you're 2 cents off, the whole frickin' form gets kicked back and triplicate and, you know. So, but that's all in compliance with the Internal Revenue Code sanctioned plan. If you screw up and you don't do it right, then that money that I just say I'm going to a conference next month in San Francisco, probably end up costing $2,000. Do I want that on my tax return as income? You know, heck no. It's not income to me because the university pays me to go travel on their behalf. So, okay, you get the point. So the question is accountable versus non-accountable plan. Okay, so what is specifically exempt from FIT? Ministers' wages, which is kind of interesting. Advances, so if you come to me and you're like, oh my gosh, my furnace went out of my house, my tranny went out of my car, something huge, I have no access to credit, I've got crappy credit. I'm like, you know what, you're a great employee, I'm going to lend you the $2,500 and take $200 a month out of your check for the next year. Okay, that's not taxable to you as it is income. Okay, this is the tuition reimbursement. So up to $5,250 a year, and this number changes every year. It's indexed for inflation. If I pay or help you pay for your tuition, then it's tax-free. There's, again, a lot of kind of additional tax protocol around that, but it can't be an education to prepare you to do something else completely different. It's kind of got to develop you in your current job status. Qualified moving expense reimbursements. A lot of areas can't get qualified employees, so they pay to move people from other markets, right? Okay, and if I cut you a check to come work for my company, that is not going to be taxable to you for federal income tax purposes. Okay, it's exempt. And again, I'm not going to go into it, but it's got to be qualified moving expenses. In other words, it's got to be a reasonable amount, and there's a laundry list of things I can pay you for, but there's a laundry list of things I can't reimburse you for too. This is, actually my son's got this too in San Francisco, in really high density urban environments. Obviously commuting's a pretty big deal, so they either will pay you for, reimburse you for your parking, they'll pay for your commuter passes, they'll pay, like he's got to cross the Bay Bridge twice a day at $11 a pop. You know, they pay you for your, the heck's that called, tolls, tolls, yeah, all that kind of stuff. Up to $255 a month, that's not taxable. That's a non-taxable fringe benefit. Okay, and again, whenever I put these figures up here and ask you to refer to those, just make a note that that means that really is something I want you to go kind of take an extra peek at. You're not going to know what all these things are, but you should just be somewhat exposed. You know, again, like in Little Missoula, Montana, 99% of us get, you know, quoted a wage, and that's all she wrote. But in more complex environments, you have a wage package, and there's a lot of things that go into it. Okay, so this is a little bit of the proverbial meat and potatoes of this chapter. So does anybody just looking at this sort of long title have any idea what this means? Pre-tax salary reductions are exempt from FIT. What's that mean?
Pre-tax is what they take out of your paycheck before you get it.
Yeah, like what?
Retirement, like 457.
Sure, contribution to a 457 plan. A 457 plan is the nonprofit or governmental equivalent of a 401k. Okay, so like here, the university, we're under a 457 or a 403b. Those are just, that's just internal revenue code speak for a retirement plan for a nonprofit or a governmental. Okay, so say that I want $500 a month taken out of my paycheck. That's a pre-tax salary reduction that's exempt from FIT. In other words, they subtract that $500 from my gross pay before they go to the income tax tables to calculate how much FIT. And I can tell you, depending upon what your tax bracket is and how much you put away, can save you a ton of money. Anything here that I'm going to talk about now, and again, I write these slides, but they get distributed all over the country, so you can't talk about any particular state, obviously, because it's a national product. But for our purposes here, whenever you see FIT, SIT is exactly the same in Montana. So when I talk about these things, they're pre-tax salary reductions for FIT and SIT, okay? Okay, so contribution to cafeteria plans. So that's an example where my employer says, here's $1,000 a month. Oftentimes happens in county government. Do you want to take cash, or do you want to choose from this laundry list of fringe benefits? Okay. Flexible spending account. These are called, these have lots of different words, lots of different ways to describe them. So they can be called, FSAs, right, flexible spending account. They can also be called Section 125s. That's the most common. When you see these two little S's, that means code section of the Internal Revenue Code. So when I call it a Section 125 plan, that means I could open up the Internal Revenue Code and go to Section 125, and it would describe what this plan is. And I would guess some of you maybe have had one of these before. They're very, very common, okay? It's where I take money out of my paycheck, I put it into a savings account of sorts, and then when I need money to pay my daycare bill, or I need money to pay my medical bills, I pull it out of that trust account and pay my medical or my daycare bills, okay? This is the only thing that I know of that you don't pay any taxes on at all. You don't pay FIT, you don't pay SIT, and you don't pay FICA. Okay. These other ones that I'm describing are only pre-FIT and SIT. So let me say that again. This guy, this 125 or FSA or however you want to describe it, is the only thing that I'm aware of that you pay absolutely no taxes on. In fact, it doesn't show up on your W-2 anywhere because it's not taxable for anything. Okay. Now,
But they're use it or lose it.
it is a use it or lose it plan. Okay, super important. Thank you for reminding me of that. FSAs, okay, for any of you that are paying daycare bills, this can help, the government's subsidizing your daycare bill sometimes up to the tune of 30 or 40% if you know how to use an FSA correctly. But if you don't use your entire FSA during the year, I think now they give you until April 15th of the next year. They give you a little bit of leeway to spend it. But if you don't spend that, you lose it. You lose that money. Okay? Oh, right here. These dollars do not have FIT, SIT, or FICA and are forfeited if not used. So in other words, if you've got a flex spending plan at your job and you don't have, because daycare bills are pretty, you know what they are. But medical bills, you know you're going to get your annual exam and you're going to go to the dentist twice and you're going to get your eyes checked. You can predict certain things and you can pencil those out. But, most of us don't know, oh, I'm going to, break my shoulder in April, right? So so they're helpful for things you can predict. Or, for example, if you know, like, oh, gosh, I've got to have my medial meniscus scraped. I'm going to wait and do it till next year and then put my copay into a flex. Then, that's really beneficial. But for stuff that just happens, you have no way of predicting that.
Why would you put it into an HSA instead, so you wouldn't worry about losing it?
Because you have to pay FICA on HSAs. So that's 7.65%. And it depends upon what your employer has. Right? So does your employer have an HSA set up? And you can only put money in an HSA if you're technically on a high deductible plan. great question. All of these instruments, you guys, are really extremely complex.
Don't you also have the ability to spend the money before you put it in there? You say you're gonna put in 50? Let's
So,
check.
yeah, and that's like, okay, for my kids' braces, I did this. So, okay, your kid needs braces, right? And it's gonna be $6,000. Shit. So the max you can put in is $2,500 a year. So what you do is you set up your kids' braces account for January, to get their braces on in January. And you take money out of your flex plan and pay your orthodontist $2,500, but then you put in the money all year long. You see what I'm saying? So I pull $2,500 out, but I fund it $200 a month all year. The danger is what? I quit. No, I quit. I take the $2,500 out. I pay my orthodontist, my kid gets his braces on, and then it's like, I got a job at University of Vermont, see ya. Right? So that's one of the reasons where, that's what you're talking about, where employers started getting more leery of flex plans, and justifiably so. So back to your question, Jonathan. So HSAs, which we're going to talk about in a second, have a lot of caveats with them. Caveats meaning requirements. There's a lot of requirements. First off, your employer's got to have one. Second off, you've got to be on what the IRS calls a high deductible insurance plan. Okay, and that's got specific requirements. Okay, so HSAs, if the employee has a high deductible health insurance, you can contribute annually to an HSA to meet out-of-pocket medical bills. The difference, well, there's a number of differences. Maybe we should put those up. The difference between an HSA and a flex what's one of the things that we just talked about? So HSA is pre-tax only for what? In other words, if I put $100 a month into my HSA, which taxes do I get out from underneath paying? Fit and sick. If I put $100 a month into my flex, it's pre-tax for what? Fit, sit, FICA. In fact, this thing doesn't even show up on my W-2. HSAs you can only put money into an HSA if you have a high deductible plan. And I honestly, I can't tell you the numbers off the top of my head because they change every year. They're indexed for inflation. But it's around $3,500 if you're single, and like around $6,000 if you're a family. What am I saying actually? If you're a single, like McKenna, single gal, if she's got a high deductible plan, what am I saying? What does that mean if she goes and has, well, WellCare is different. Under Obamacare now, WellCare has got to be covered.
You got to pay the deductible.
Yeah, she's got to say she breaks something, or has to have a minor surgery. She's got to pay the first $3,500, right? Which makes it a high deductible plan according to the IRS. Okay. If she's got a plan that says you only have to pay $500, then she's not on a high deductible plan and she's not eligible to make an HSA contribution. high deductible plan has different amounts based upon if you're single versus you're a family. Okay? No requirements on the what kind of plan you have. Okay? Now, here's the biggie. HSAs roll from year to year. My husband started on a high deductible plan at his place of employment like 3 years ago. And so we can make a contribution to the HSA. And so we do that every month. And then we don't use it 1 year. Guess what? It doesn't go away like a flex. It rolls over into the next year. Okay? And what actually ends up happening with an HSA is that if you don't use it, it can eventually, and again, I'm simplifying something fairly complex, but you can eventually roll it into a retirement instrument of sorts. Okay? So it's a funding mechanism to kind of cover your ass for medical bills, but if you don't use it, eventually we can withdraw those funds once we're 59 and a half and blah, 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 as a retirement instrument. And again, I'm really simplifying this. If you're super interested, come take my income tax class. You guys are like, are you kidding me? Hellish. No. Actually, income tax is pretty fascinating stuff. Just what Klaus said, use it or lose it. Don't quote me on this exactly, but I believe there was such an outcry over this because people were losing their money that the IRS now gives us, it's until April 15th of the next year. So say I'm sitting there on 12/31 and I still got $800 left in my flex. And it's like, shoot, you know, I didn't spend this. They're like, oh, now you've got until April 15th. So I'm like, I'm going to go get that cap done on my tooth that I need, or that crown or something, right? They give you a little leeway. Yep. Question? No. Okay. Those are the big differences off the top of my head. Questions? Anybody here been in either of these? You said you'd been in a flex. Which one have you been in?
HSAs.
Did your employer put in or just you? Okay, and yeah, that's worth saying too. HSA can be any combination of employee and employer contribute. So in Jonathan's case, he's saying he put in. Where at my husband's place of employment, I can't remember exactly what it is. I think that they match them, but the employer puts in a little bit of money too, right? Okay, so it can be any combination, or you know, maybe you're really lucky you've got just the employer puts into it, and you don't have to. Actually, I don't think that you can do that. I think it's either employee or both. And flex only you put into it.
So in the long run, it almost seems like HSAs would be more beneficial.
Well, bet you're paying another 7.65% premium then to, you know.
Flex works great for like if you get benefits, but you gotta pay for them and you know they're this much every month.
Absolutely.
Then you just have them deduct that much every month.
Absolutely. I mean, for me, I think at one point I was calculating when I had 2 little kids in daycare that it was saving me something like $200 or $2,200 a year in taxes.
Like
Because you pay no FICA, no FIT, no SIT on it. So, you know, $5,000 or $6,000 a year of my daycare bill, I was paying with completely pre-tax dollars. I mean, the math on that was huge.
If your employer provides you with coverage, but then you have to pay for your wife and your kids.
Sure.
You just put
Another
that
great
amount
example.
On it, and then it just comes out.
Absolutely.
But you're gonna pay it anyway.
The thing is, you guys, these are hard to sell because people don't understand them. people don't understand. What do you mean you're going to take money out of my paycheck and send it somewhere else, and I can't get my own money out till I show a daycare receipt? It takes a whole nother level of money management, which a lot of people either A, just don't have, or B, they don't really get the implications of the savings. I watched my husband, I helped him, he's the controller for the youth homes, and he has to go around and explain to 180 employees these plans. And I've helped him kind of, because he's not really an educator at heart, helped him kind of set up the programs to explain to people and run numbers, and he's like, that didn't work at all. He's like, I came back, everybody's still just sitting there going, huh? And like one person signed up. And he's trying to show like this example of how much it's going to, save you, but people just don't always, get it. Okay, I'm not going to go into archers just because there's so very few of them around. Okay, this is what I was talking about before. Retirement plans. And what exactly is this again? These are all code sections, aren't they? Code section 401k, code section 403b. So if I want to understand what's going on in my plan, I pull out the Internal Revenue Code, all million pages of it, and I look it up. Okay, I'm being facetious. Actually, your employer's got to provide you with a plan document that says here's how the plan works, and that'll put you to sleep darn quick. Forget the Ambien, just go straight to the plan. But basically what all this says is, all these plans say, is that if you put money in pre-tax while you're working, that money's going to grow tax-free, right? So every year that money that you put in earns money, right? Hopefully. Yeah, hopefully it earns money. God bless. And you don't pay tax on that over the years. Then when you retire, what happens? You start pulling that money out, and then you pay tax on it. Why would you want to pay tax on something when you're retired?
Because by then you're in a lower tax bracket.
Most of us will be in a lower tax bracket when we retire. Not true. I have a number of clients that I don't recommend this to. Instead, I have them in Roth IRAs, which is exactly opposite. No deduction while you're working, no tax when you pull it out. Those are for clients that expect to be in a higher tax bracket when they retire. Who the hell's going to be in a higher tax bracket when they retire? People that are selling their business, selling their land, or inheriting. Okay? I expect my folks to pass in my 60s and their estate's worth a couple $1,000,000. Kidding. I'm from dirt farmers in South Dakota, but if that were my story, I would be doing a Roth, right? Okay. Now, all these plans have different, where am I? So these all have different amounts that you can put in on an annual basis, okay? And then all of them, so they're not the same amount, and they change every year. So I'm not going into all that. But just be aware that in any sort of instrument under Obama, we're allowed to put in additional amounts pre-tax once you hit 50 years old. 80-some% of Americans are, what's the term? Grossly, or I can't remember the two words, like are pretty much or really screwed. In other words, they've undersaved significantly or grossly. Those are the two words. 80-some% of Americans have significantly undersaved or grossly undersaved for retirement. We have no idea of the crisis that we're going to see in our retirement communities in the next 20 to 25 years as baby boomers are starting to retire in bigger and bigger numbers, and there's fewer of you guys out there working. So I've grossly undersaved my Social Security. Obviously, that whole pyramid's got to shift pretty dramatically. And then I haven't saved enough to make up even for what I should have, more or less, the pseudo collapse of Social Security as we know it. So that's gonna be a big, combined with rampant increase. Assisted living now, even in our little town of Missoula, Montana, $8,500 a month. 85, it doesn't matter how much you've saved, if you've earned average wages in Missoula, Montana your whole life, like we're really good savers, and I mean, something like that can bust anybody in a couple years, so, I don't know what my lesson is here, other than start to save young and a lot, and stay healthy, but don't live too long.
Only live as long as you got money.
Right?
Don't outlive your money.
Huh?
Don't outlive your money.
Yes.
Disperse it before you don't. It's all gone.
Yeah, I don't know what the lessons are. The lessons are, I don't know what all the lessons that I grew up learning, are kind of obsolete. And for folks that are young, I don't even know what to tell you. Work hard, save a bunch, don't get in debt. Okay, is that good advice? I'm looking at you because we're the same age.
The rules aren't the same.
The rules are not the same. Okay, IRAs. IRAs and Roth IRAs, which is what I was talking about before, are instruments that you could, okay, so let me back up, sorry. So the last slide, all the 401k, 403b, simple, blah, 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 those are all things your employer sets up. You can't be in one of those unless your employer sets one up, right? So what do? You can set up your own Roth, or you can set up your own regular IRA. That's just calling your bank. Like, I want to set up an IRA or a Roth IRA. I'm simplifying this again. You've got to have some minimum amount to get into it. Okay, so you can't call up and be like, I've got $25. Okay, because your annual fees are like $79. So you've got to have a minimum buy-in. How do you get the minimum buy-in?
Save.
You save for it. And I mean, I think I've told you this before. I mean, I made my kids start doing that the day they got out of college. You start putting $75 a month into this savings account, and when you get to $2,000, we can get you a buy-in into your IRA. Okay? That's going out 1 weekend a month. So, so they can do this whether or not their employer has one. Okay? This is the guy where you get the deduction now, and then you pay tax on it when you take it out. And again, for most people, your tax bracket's going to go down in retirement, right? So this would be a reasonable choice. $5,500 a year, or an extra $1,000 if you're 50 or over. So you can put up to $6,500 a year in if you're over 50. Okay. And again, there's a lot more complexities to it. If you're super high income, it starts to phase out, blah, blah, blah. A Roth IRA, other way around, I don't get a deduction now. I don't pay tax on it when I pull it out when I retire. All those earnings grow tax-free for 20, 30, 40 years. That's the value.
You can't touch it till you're 59 and a half.
You can't touch any of these without penalties until the year in which you become 59 and a half. And you have to start taking out from them by the time they're called minimum distributions, by the time you're 70 and a half, because the IRS doesn't want you to die with these things, because, and this is again probably beyond our scope, but your heirs get a stepped up basis, and the IRS loses income tax on appreciation. They don't like that. So you got to start taking money out of it by the time you're 70 and a half. If you touch these things before you're 59 and a half, you pay a 10% penalty and all your taxes. So the people, I had a number of clients during the Great Recession that are like, dude, I lost my job. And I mean, I always like bitch and moan and kick and scream at clients that are like, I'm going to take money from the IRA. And it's like, okay, so do I do that or do I lose my house? I'm not eating. I can't pay, I don't have a job. So then they're taking their money, They've saved their whole life. They've saved $60,000, let's say, and you kiss 25 of it goodbye to taxes and penalty. It was a very, very sad thing to see.
Same with profit sharing too, right?
Same with profit sharing. Anything that's a pre-tax instrument like this, you're going to get hit with everything. Super painful. Okay, so what time is it? They took our clock down. 1:28. Tell me when we hit about like 1:38, and then I'll hand you back your test. Okay, so the magic question then is, you guys all work for me. What amount do I withhold from your paychecks, right? So people always want to know that, like, how much should I have withheld? Should I choose 0 or 1 or 2 on my W-4? Okay. I would never advise any of you anything until I knew your entire tax situation. Are you married? I need to see your 2 years prior tax returns. How many kids do you have? Are any of them disabled? How old are they? Do you have rentals? Do you have interest income? You can't tell anybody what to do with their withholding for income tax purposes on their job unless you know their whole tax picture. So if you're processing payroll for your employer when you get out of here, or you own your own business and somebody comes to you and goes like, I don't know what to do with this dude, do not ever recommend to somebody what to do on their own W-4 unless you're a tax advisor. Okay? Because they're going to come to you at the end of the year and be like, I owe $3,000. WTF? And it's like, oh, you forgot to mention you were a trust fund kid getting $5,000 a month in income on the side. Like, how would you know that? Right? Okay. So, what's a W-4? A W-4 is what you fill out when you walk in the door for a new job. Then at the end of the year, I issue you a what? A W-2. Here's what a W-4, just in a straight up situation with no special anything. You get up to 1 allowance for yourself, right? So you can choose 0 or 1, and then 1 allowance for each dependent, okay? And a dependent isn't just necessarily your kids. You might be raising a grandkid or a niece, or you might have a dependent parent or disabled sibling, or so it's not just your kids, okay? And then there's a bunch of special withholding allowances. If you've ever filled out a W-4 and actually read the whole thing, again, really fun reading, and then flip to the back side, there's all these worksheets you fill out. So if you've got anything going on in your life other than, I got me a job, I pay my rent, I got a dog, then you should probably kind of look at that, because there's a lot that can go into it. Okay, so I fill out my W-4, I give it to my employer, and then my employer has got to use that to go to the tax tables to determine how much income tax to withhold for my checks. Okay, can you open your books to chapter 4? And I apologize, I've been sharing my book with somebody in the library, so I don't actually have it. Oh, well, yeah, but then what are you going to do? Okay, thank you. Chapter 4, let's find a W-4.
Really, don't people just choose based on whether they want to break even or owe or get money back, right?
Yeah, most people aren't honestly that sophisticated. Page 4-11. Okay, so I'm looking at the form and kind of the screen. So the first thing, other than your name and social, is in line 3. Are you single, married, or married but you want to withhold at a higher single rate? Why would anybody choose to have a withholding at a higher rate?
If you do work on the side, maybe?
That's exactly why you do it. I do that. I don't and I mean, I manipulated in a lot of, well, not manipulated, I don't mean that, but I bad choice of words, strike that from the recording. But I have side businesses. So rather than have to make these big quarterly payments, I'd rather that some of that goes through the university every month on my check. So I ask them to do that. Please, please withhold at a higher rate for me. Okay, so that's one thing you can do. The second thing you can do is down, where am I? Oh, on line 6, I want to have another $300 a paycheck held out. So that keeps me from, say, having to make estimated payments, which is a pain in the butt. And I'd rather not have to do it once a quarter. I'd rather that I take a little bit of a hit every month. Okay, so that's how you can kind of manipulate that. Again, that word, but it's a fair word. I'm not manipulating my bill. I'm manipulating how I pay as I go. Now, here's the key down here under this note. Note, IRS doesn't pay interest on over-withheld taxes. If you're using this as a means to save, you're way better off actually putting it in a savings account. What am I talking about? I've got a number of clients who, you know, some people, honestly, they just simply can't save money. Okay, it's just not how they roll. And one of my kids is like that. So what do we do with him? We have more tax taken out every month than we should, way more. And then he gets a chunk back once a year, right, on his income taxes. And then his mom takes it and invests it for him. Okay. Just saying. Some people really, they do need that extra help. Okay. That's not really a very good way to do it. How come? Yeah, the IRS holds on to his money all year for free. Okay. So it's not really how you want to do it, but honestly, for a lot of people, that's the only way they're ever going to save. Okay. Okay, so that's that. Now, the next thing is this box 7. You can only claim box 7, so it says, I claim exemption from withholding, and I certify I meet both of these conditions. In other words, do not withhold any income tax from my check because I'm certifying that last year I had a right to refund all my federal income taxes. In other words, I had 0 taxable income. And this year I expect the same thing to happen. So for any of you students, regardless of how many kids you have or whether you're married or whatever, the total of your standard deduction, just something we all get, plus your exemption for just yourself, regardless of your kids, which is something we all get, is around, for this last year, was around $10,300. So if you work part-time and make less than $10,300, you are exempt. You're not going to pay any income tax. So really, why do you want your employer taking, you know, $108 a month from your paycheck? And then you got to wait all year and file a tax return to get it back, right? Wouldn't you rather just have that $108 a month?
So is that before or after?
That is your tax.
Okay, but if you make less than the 10.5?
Oh, I see. So the 10.5, I'm talking about gross income. So the way, or 10.3 I think it was last year, and about 10.4 this year. Okay, and again, if you've got kids or you're head of household or any other situation, so I'm not giving you blanket tax advice, I'm saying in the simplest situation, you know, there's no reason that you should be paying in tax every month because you're going to get it all back. Okay, so that's exempt. And that's where you write exempt, line 7. Okay, blah, blah, blah. This is if you're a dependent on someone else's tax return. So I'm a student, but my folks still claim me because they pay more than 50% of my living expenses. then you've got a whole nother set of numbers, which I'm not going to go into. No, never advise anyone how many allowances to claim. Thank you. Okay, that's a good, one more slide, and then that's a good breaking point. If your employee doesn't give you a W-4 when you tell them to give you a W-4, you withhold at the highest rate, single and zero. If an employee changes their W-4, say they lose custody of kids or they get married or whatever mid-year, obviously you've got to input that into your payroll system, and you've got 1 month to do that. Okay. So let me turn this off and I will hand out your tests.